Another cost of inflation is that inflation interacts with other taxes. The taxes that we pay are based on nominal income and are not adjusted for inflation. Therefore, inflation causes people to pay more taxes even when their real incomes don't increase. So let's look at some examples to see what this means. Let's suppose you deposit $1,000 in the bank for 1 year. In one case, the inflation rate is 0, and the nominal interest rate is set at 10%. In the second case, the inflation rate is 10%, and the nominal interest rate is set at 20%. What is your real return in each case? Well, in each case here, the real return is the difference between the nominal and the inflation rate, or the real return is 10%. So what have we learned here? Inflation increases the nominal interest rate. This is an example of the Fisher effect, but not the real interest rate. The real interest rate will stay the same at 10%. Let's suppose that we now have a tax. The tax is going to be imposed on your interest, and the tax rate is 25%. Now, in which case 1 or 2, are you going to pay the most in taxes? Well, in case 1, your interest income is going to be $100. You're getting 10%. You're getting a 10% nominal return on the $1,000 that you deposited. So you're going to get interest income of $100, and you have to pay taxes on that interest income. At a tax rate of 25%, you're going to pay $25 in taxes. In case 2, the nominal interest rate is 20%. In nominal terms, your interest income will be 20% of the $1,000 or $200, and you're going to pay 25% on that $200. 25% of 200 means you're going to pay $50 in taxes. So what we see is that inflation is going to increase the tax burden on the savers. In each case, the real return is 10%, but because of inflation, the inflation increased the tax burden on the savers. Finally, let's look at what the after-tax nominal interest rate is, and then calculate as well the after-tax real interest rate for each case. So in case 1, on every dollar that you deposit, you're going to earn 10%. Of that interest income that you earn, you only get to keep 75% of it, because the other 25% is going to be taxed away. So you're going to get a nominal return of 7.5%. In real terms, though, we have to correct for inflation. So I take that nominal return of 7.5%, subtract the inflation rate of 0%, and I have a real return of 7.5%. In case 2, I'm getting a 20% nominal return on every dollar. So 20% nominal return on every dollar that I deposit. Once again, because of the tax rate at 25%, I only get to keep 75% of it. The rest goes to the government. So that gives me a nominal return of 15% on every dollar saved. But in real terms, I take that nominal rate, subtract the inflation rate of 10%, and I see I only have a real return of 5%. So what do we learn here? Inflation is going to lower the after-tax real interest rate. So here's another thing about inflation. It creates tax distortions.